I joined a credit union my teen years, and they were always talking about share certificates or my share account and just other words that didn't make sense to me. So I did what anyone in my position would do, and I ignored them. But obviously I'm a finance nerd now, and I've learned that there's actually some pretty big differences between these savings accounts at a credit union. Let's decide which might be the best fit for your savings goals. If you're with a credit union or you're considering joining one, the first thing to know is that one of the primary differentiators between this and other financial institutions is the fact that credit unions are not for profit and instead distribute their profits amongst their members. These distributions usually come in the form of interest rates on savings or lower interest rates on loans. Banks, whether large, small, or virtual entities, are all for-profit businesses. So when you hear many credit unions use terms like share or share draft or share certificate, note that these are the wordings used because you are a member and part owner. A share account and a share certificate are both savings accounts at a credit union. So with either, you deposit your funds and you'd receive interest on the funds over time in return for letting your financial institution use the money, like to issue loans to other members, for example. Credit unions typically come with basic eligibility criteria to become a member. These criteria will vary, but may include employment, military, or community affiliation. There are also some credit unions that will allow anyone to become a member by joining a partner organization, such as becoming a member of a partner nonprofit organization, for example. Both also come with National Credit Union Administration (NCUA) insurance up to at least $250,000. The similarities between the accounts typically end there. A share account is what you might think of when you think of your run-of-the-mill savings account, right? This is the account where you can tuck money into for your future goals and take money out as you need to, like if you're saving up for your emergency fund or saving money for a big purchase you have coming up. Whatever your plans for the money, the beauty of a share account is that you have access to the funds as you need it, although that might come with some limitations. You may opt for a share account at a credit union over a savings account at a bank if you want the space holding your money to align with your moral preferences. Credit unions tend to look for opportunities to give back to their communities and the world around them. Credit unions may focus on strengthening their local communities by delivering financial education programs, funding charitable causes, hosting community events, and providing loans and grants for small businesses and neighborhood development plans. As a member, you'd get to vote on major decisions of the institution, and the board is typically comprised of volunteers that you will have the option to vote on as well. That said, there are some downsides that come with a share account. For starters, your interest rate can fluctuate. Now, this isn't limited to credit unions. Just like with most financial institutions, your savings account interest rate can increase or decrease based on the needs of the credit union. Credit unions offer interest rates on funds as a means of enticing depositors to provide extra cash so that the institution can make loans. When your credit union wants extra deposits, they can raise the interest rate offered on share accounts to attract extra cash. If they want to decrease debits, they can lower interest rates. Also, as I mentioned earlier, you may face limitations when accessing your funds in a share account. Some credit unions may limit you to 6 withdrawals from the account monthly. You also might find it difficult to access your money for free if you're traveling and not near the credit union itself or a shared branch or an in-network ATM. You also might get hit with ATM fees, withdrawal fees, or other unexpected expenses. So make sure you read through the fee schedule very carefully. Now, while the emergence of high-yield savings accounts at online banks and fintech institutions means you may not be able to get the nation's top APY, the annual percentage yield, at a credit union nowadays like you used to, you might still find better rates with a credit union share certificate over a certificate of deposit at a bank. So let's segue into how share certificates differ from share accounts. A share certificate is a type of savings account with a fixed rate where you put your money away for a fixed period of time. Share certificates are the credit union equivalent to certificates of deposits, CDs, which you can get at banks. A share certificate will likely have a higher APY than a share account, which can make them a great place to stash money you want to use for a big purchase down the road. Like if you know you want to buy a house in a year or two, locking the down payment money in a share certificate might be a good way to go. I say locking the money because you don't have access to the funds in the certificate for the fixed term. Term links can be as short as 1 month up to as long as 10 years. But where the national average for a credit union share account interest rate was 0.19% in September of 2023, a 1-year certificate averaged 3.01%, which is a significant difference. And remember, these are averages. Some certificates rates were as high as 5.25% last fall. While these numbers are definitely attractive, the downsides are fairly obvious. You won't have access to the funds for the set term of the certificate. This means, should you have an emergency need to withdraw any of the funds, you're likely looking at some pretty harsh penalties to do it. These penalties can be several months to years worth of interest. You also can't add funds over time, which is a key tool for everyday savings. Plus, while many share accounts these days don't have a minimum balance requirement, a certificate usually will. The minimum deposit amount will vary depending on your credit union, but they typically start around the $500 to $1,000 mark. If you don't think you can part with your money for the fixed term length of the certificate, it might be best to stick with a regular share account. So, which is the right savings move for you right now? It depends on your savings goals and needs. If you have more basic savings needs and you'd like to have normal access to the funds, and you don't mind forgoing some higher interest benefits in order to get it, a share account sounds like it might be the best fit. You can connect this to your share draft account, also known as a checking account, and you can transfer funds in and out as you'd like. You could also set up a few different share accounts for different goals, like one for your emergency fund and another for saving for a big expense you have coming up, like if you wanted to go back to school or something. And you could easily have the funds directly deposited from your paycheck to the share account to help automate your savings. If you don't need access to the money right away, and if the idea of it collecting virtual dust by not earning interest is upsetting, then a share certificate might be the way to go. Like for example, if you were to stash $10,000 that you plan to use for a home down payment in a certificate for 2 years, and it was earning a 5% interest rate in that 2-year certificate, you'd have $11,025 at the end of the term. If you were to let that $10,000 sit in a share account that has a 0.25% interest rate for 2 years, you'd have $10,050.06. That's a difference of about $975. The more you stash and the longer you stash it, the more time your interest has to compound and grow. And just one more thing. There's no rule that says you have to have one over the other. In fact, if you do decide to open a certificate, I'd still encourage you to have a regular share account for your everyday savings needs. You'll always want ready access to your emergency fund at minimum in case of an emergency. So maybe you lock up some of the money in a certificate and you keep the rest liquid to have easy access. The goal is to create a savings plan that makes the most sense for you and your long and short-term goals. Still deciding if a credit union is the right fit for your banking needs? I get it. Check out my video breaking down the key differences between credit unions and big banks right here on the NerdWallet YouTube channel. I'll see you there.